In this video, I'm going to analyze automobile companies like Maruti Suzuki, Mahindra and Mahindra, Tata Motors, Ashok Leyland and SML Issues. These companies are in manufacturing of automobiles for passengers as well as commercial purposes. Maruti Suzuki's current market price is 6,852 rupees per share, and it is down from its 52 weeks high by 30.99%. Other companies too have fallen more than 30% from their respective 52 weeks high, except SML Issues, which has just fallen 11% from where it was 52 weeks back. There has been a change in the entire sector in terms of rules and regulations of the government. There was also some issue recently about NBFCs. Most of these automobile companies sell their products through financing options, which due to NBFC issues was directly affecting their sales, other than the government regulations. There are also external problems like trade wars between US and China and so on, which are directly affecting the entire sector. The Maruti Suzuki's earning per share was 248 rupees. Mahindra and Mahindra was trading at 46 rupees. Tata Motors earnings per share is not available because the company has made a loss in the latest year. Ashok Leyland's earning per share was 6 rupees and SML was at 13 rupees. The earning per share, if high, does not mean that the company has earned more per share. We need to compare this with the price. On the current price, what was the earning that the company had per share? That gives us an yield, which is the earnings per share yield. Maruti Suzuki's earning yield was 3.62%. On a price of 6,800, it managed to earn 248 rupees in the recent year. The latest data that I have available is up till 2019 March. Mahindra and Mahindra yield was 7.2%, which is very good. Tata Motors yield is not available because the company had no earnings per share. Ashok Leyland's yield worked out to 7.52%, again very good. And SML Issues was the lowest at 1.68%. So the highest earnings yield was by Ashok Leyland and the lowest yield was SML Issues. Moving on to the 5 years historical price earning and 3 years historical price earning, we understand where the price is compared to its earnings. Or in other words, investors are willing to pay how much or how many times more than the earnings. That is the PE ratio or price to earnings ratio. On an average, since last 5 years, the price was quoting 24 times higher than its earnings. And in the latest year, we saw that the earnings was 248 rupees and investors were willing to pay currently 27 times more for the earnings to buy the share at 6,852 rupees. This is how we calculate the price to earnings ratio. Last 3 years historically, the price was trading much higher at 27.9 times its earnings. The current price earning is also somewhere around 27.6%. As investors, we would want to buy the company's shares below 25 times its earnings. In other words, we don't want to pay a very high price against what the company has earned. So for example, if the company has earned 1 rupee of profit per share, what is the multiple we are willing to pay to buy that share? So here it shows that investors were willing to pay 27 times recent earnings. So the recent earnings was 248 rupees per share and the price was 6852 rupees. That is, it was 27.6 times higher than the earnings. Let us check out the historical price earning and the latest price earning for other companies. Mahindra & Mahindra since last 5 years has been trading at 17 times more than its earnings, whereas in the recent 3 years the price earning multiple was 19 times. In the very recent or the latest price to earnings comparison has fallen to 13.7 times. So we see that the price earning multiple has been falling from 5 years and 3 years and currently at 13 times. So this is a good entry point provided other ratios are as per our criteria. Tata Motors historically has been at 12 times its earnings, whereas price of Tata Motors in the last 3 years was trading at 14 times. The recent price earnings data is not available because the company had loss in the latest year. That is, there was no profit or there was no earnings per share. Ashok Leyland historically had the highest price earning multiple of 70 times. Even in last 3 years, the price earning multiple was very high at 48 times. The current price earning multiple is very attractive at 13.2 times. SML Isu's both 5 years and 3 years multiples are very high at 45 times and 57 times. Even the current price earning multiple is very high at 59 times. That is, for an earning of 13 rupees, investors were willing to pay 804 rupees per share. So historically, 5 years and 3 years, Tata Motors was available at the cheapest multiple of 12 and 14 times. Whereas for the latest price earning multiple, Ashok Leyland is the cheapest stock, available at 13 times its earnings. The worst performing stock for 5 years was Ashok Leyland at 70.5 times its earnings. Whereas in the last 3 years, SML Isu's was available at 57 times. These are very expensive multiples. In the latest price earning also, SML Isus was trading at 59 times its earnings. As I mentioned, just because the price earning multiple are very low does not mean the company is very good or we are buying at a very attractive price. For every ratio, we have to cross compare it and recheck it against all the other ratios. Even if this ratio is very good, does not mean that we can completely rely on one ratio and invest. We will have to cross check with other ratios. As we go down, we will understand why Tata Motors is not a very good bet as of today. Even though it's available at the lowest price earning multiple. Let us check the price with the OCF or the operating cash flow. OCF is calculated by considering the money that comes into the business, that is the cash coming into the business or going out of the business during the operations of the company or through the operations of the company. The OCF does not consider the investment activity, the money coming in or going out of the investment activity, as well as financial activity. As we go down and look at other ratios, I'll explain the cash flow from operations in further detail. As of now, the thing to understand between the price earning and price OCF or price cash, what we need to understand between the two is that the earnings considers all cash as well as non-cash expenditures done by the company in all its activities, whether it's operations, investment or financing. Everything is considered to come to the price earnings or earnings calculation, whereas the cash or the OCF only considers, as I mentioned earlier, the money coming in or going out of the operations of the business. So here too, we don't want the price to cash ratio to be more than 25 times. We should not pay a multiple which is higher than 25 times. Maruti Suzuki price to cash was at 17 times, which is much lower than the price earning. This is what we would want to see as investors. These ratios are based on certain criteria that they should meet before we can invest in the company. Mahindra and Mahindra's price to cash was very expensive at 115 times. What it shows here is that the company's cash has not come in. These ratios are of the current price compared with its latest cash earning data. In this case, the cash data available is of 2018, whereas earnings data is of 2019. Nonetheless, the company's cash was not very good coming in. It was 115 times more than the price, or the price was 115 times more than its cash earnings per share. Tata Motor was available at just 2.2 times its cash earnings, which is the best ratio when compared with the OCF. Ashok Leyland stock also was available at a reasonable 4.8 times its cash earnings. SML Isus had a negative price to cash. Now, when we see a negative value in the OCF, it means the company has spent more than what it has earned through its business operations. The company's cash management is not up to the mark and it had to spend more than what it earned. We would also not want to see a negative figure as well as a very high value like in Mahindra and Mahindra. The best performing stock in terms of price to cash comparison was Tata Motors, available at just 2.2 times, and SML Issues had a negative cash flow, so it was the worst performing of the lot. Let us check the price with the book value. All these three ratios, price earning, price cash and price to book, they are valuation metrics. They help us understand where the price is compared to its respective earnings, cash and book value. The criteria for book value below 2.5 times. The price to book value as such should not cross 2.5 times. Many companies do trade above 2.5 times, but those are given a premium by the investors. But as value investors, I personally would not want to invest in a company which is trading at a very high multiple. Maruti Suzuki's price to book value is way above 2.5 times. The price to book value currently is 4.4 times. The book value is also known as the net worth of the company or net worth of each share, or in other words, the actual value of the share as per the company's records. Now, if the company is saying its shares value is 1 rupee, then in this case we are paying 4.4 times its actual value to buy that share. So that is why I say buy it at a reasonable valuation. Anything below 2.5 times, taking into consideration other ratios as well. Mahindra and Mahindra is currently trading 2.14 times above its book value. Tata Motors shares is trading at a discount. In fact, the price has fallen below what the company has suggested that its shares are worth. Ashok Leyland's share is trading at 3.14 times and SML Issues is trading at 2.82 times. Most of these companies are expensive and trading at high multiples. So as for the price to book value, the cheapest one again is Tata Motors, available at a discount to its book value, and the most expensive is Maruti Suzuki, trading at 4.4 times above its book value. Now moving on to the PEG ratio, or the price earnings to growth comparison ratio of the last 5 years, and the price earning to profit growth rate in the last 3 years. What we understand from this ratio is that we calculate the price earning, that is how much time more are we paying against the earnings of the company, and what is the earnings growth we are getting from the last 5 years or from the last 3 years. So this helps us to understand, although we are paying 27 times, the earnings is also growing at a high speed, so we don't have to wait for 27 years to recover our capital. When there is a profit growth, that earnings growth can help us recover our initial capital much faster. Although we will still have to wait for it to fall below 25 times before we can enter. Many stocks would not go even below 25 times and would always remain high because the investors value these kind of blue chip companies at a high valuation. So it all depends on the investor where and how much risk he wants to take in terms of entering at a high price or a high valuation. For the PEG, we would want to see the PEG between 0, that is above 0, and below 1.5 times. when we have a ratio of 0 to 1.5 times, it helps us understand that the price earning multiple we are paid is a justified price earning multiple, and our investment will be recovered much faster. So for a price earning multiple of 27 times, you are also getting a growth of 24% since last 5 years back, and 25% of profit growth rate from last 3 years back. Now these are good profit growth rates, and therefore the PEG is below 1.5 times. Let us look at the other companies' PEG and profit growth rates. PEG of Mahindra & Mahindra is at 1.5 times, and for 3 years it is below, or it is at 0.56 times. So for the last 3 years, the price earning multiple that we are paying, that is 13 times, is justified because we are also getting a good growth in profit of 24%. Tata Motors PEG ratios are not available because we do not have the price earning data. Ashok Leyland's PEG is 0.23 and 0.16, the best of the lot, because we are paying 13 times the earnings, and that earnings is having a high growth rate in the last 5 years at the rate of 56% and 82% in fact in the last 3 years. So these are very high growth rates. SML Isu's PEG is negative because it's had a degrowth in its profit from last 5 years, and from 3 years back it had a degrowth in profit at the rate of 40%. This is not a loss, it's just reduction in the growth of profit. So the best performing stock in terms of price earnings to growth comparison, Ashok Leyland has done the best. Even in the last 5 years profit growth rate and 3 years growth rate, it has done the best. Whereas SML Isu's had the worst performing PEG ratios as well as degrowth in profit. Let us look at the sales growth rate of the last 5 years and sales growth rate of the last 3 years. How the sales has been growing for the company from 5 years back and from 3 years back. As I mentioned earlier, the data available is up till March 2019. So Maruti's sales has been growing at a steady rate of 12.8% from 5 years, and from 3 years back it has been growing at the rate of 16%. So the sales has picked up a pace in the last 3 years. Let us compare this with other peer group companies. Before that, as investors, we would want to see a profit growth rate of at least more than 10%. Mahindra & Mahindra sales has been growing at the rate of 6% since 5 years and 8% since 3 years. Now, most of these data would be looking very boring to continuously hear the numbers and the percentages, but then that's the fact. If you want to invest your money wisely, we will have to look at these numbers. Ultimately, what is profit? Profit is also a number, and if you don't give time or devote time to understand these numbers, how do you expect that your investment would grow and give you some kind of benefits? Tata Motors sales from last 3 years and 5 years has been growing at the rate of 3.8 and 9%. Ashok Leyland has managed to grow its sales at a very high pace of 16% since 5 years and 23% since last 3 years. SML Isu's sales had below par and since 5 years it has just managed to grow its sales at the rate of 2.52%, and in last 3 years at just 0.8%. Sales is a very important value or metric that we investors should look at. Sales gives us an idea or a estimate as to how the company's management quality is, how fast or how well the company is able to sell what it is producing. Ultimately, companies are made to produce something and sell something, and if they are not able to sell those goods and products, it ultimately affects our value, our investment that we have done in the company. Again, in terms of sales, the best performing stock is Ashok Leyland, managing to grow its sales as well as its profit from last 5 years and even from last 3 years back at a healthy growth rates. SML Isu's sales is down as well as profit had a degrowth from 5 years and 3 years. Next, let's look at the return ratios, return on equity and return on capital employed. These return ratios measure what is the company's profit when we compare that with what the shareholders have invested, or in other words, what is the company earning on the shareholders' money, and what is the profit that the company has been earning on total capital employed in running the business. Here we want to see a growth rate of above 15%. Maruti has managed to grow or earn a profit of 15% on the shareholders' money from last 5 years and 21% on the capital employed in the last 5 years on average. These are healthy growth rates which we should look for in any company where we invest. Mahindra and Mahindra's ROE and ROCE is below 15%. Tata Motors has managed to grow or earn a return of 17% on the shareholders' money in the last 5 years, and on the total capital employed it is 14%. Ashok Leyland's return on equity is 13% and capital employed is 15%. And SML Isu's ROE, ROCE are 10% and 13%. In terms of ROE, the highest ROE was earned by Tata Motors in last 5 years, and the worst company was 10% of SML Isu's. Return on capital employed was best earned by Maruti Suzuki of 21% in last 5 years on average, whereas Mahindra and Mahindra had the lowest return on its capital employed of 13.5%. Next, let us look at the profit that the company earned in last 5 years and compare that with the cash that the company earned against that profit, meaning of the profit that the company earned, how much got converted into the cash. Here we want to see a 100% conversion rate or even more than that when compared with its earnings. So Maruti earned a total profit in last 5 years of 22,300 CR, against which its cash component was 41,000 CR, which is 87% more than its earnings. This is, as investors, this is what we need to see, that the cash component is more than the earnings. Mahindra and Mahindra profit was 19,600 CR in the last 5 years, whereas the cash coming into the business in last 5 years was just 4,000 CR, which is way too less than what the earning the company showed. That is 79% below its earnings. The cash was short by 79%. This is not a healthy sign for any company. Some companies would have a negative cash flow where the company is spending more than what it is earning. But when we look at good companies, we see that they invest proportionately to what they earn, and this way they steadily grow the company. When the company starts investing more than what they are earning, it directly affects a lot of other ratios and lot of other things that goes out of controls sometimes. Tata Motors has earned more cash than what it showed as earnings in the last 5 years. Its cash was 193% more than its earnings. Ashok Leyland cash was 227% more than its earnings, whereas SML Isus had a 71% more cash coming in than its earnings. All of these companies have earned a good cash against their earnings. So in terms of CFO to PAT comparison, we see that Ashok Leyland has earned the highest cash against 3,540 CR of earnings. It has received a cash of 11,589 CR, that is 227% more than its earnings. Whereas Mahindra and Mahindra has performed the worst in terms of cash earnings. Its cash has fallen by 79% over its earnings. Next, let us look at the free cash flow of the last 5 years. This ratio measures, or this value measures, what is the cash available with the company after it spends on its operations or whatever it receives from operations, and also spends or receives through its investment activity. So these two activities, that is the operations and investment, together constitute the free cash flow. Whatever remains after that constitutes the free cash flow. So what we are going to do is we are going to compare this free cash flow with the operating cash flow from operations. That is, out of the 41,000 CR that Maruti earned in cash, how much was still left with the company as a free cash? So we see that the company spent 39% of its cash and it still has the balance with it. So out of 41,000, it still has 25,440 CR left in cash for financing activity, that is either to pay off as dividend or to do buybacks or to issue bonus shares or maybe for acquisition. So we want to see a value which here does not exceed more than or falls below 50%. That is, of the 41,000, it should have not spent more than 50% of that in the investment activity. Some companies would have to spend, but we would want to see a very stable growth rate in any company that we invest. Mahindra and Mahindra's cash from operations was 4,061 CR in the last 5 years, whereas it has spent more than 19,000 excess amount into investment activity. So now it has a negative free cash flow, which is never a good sign. We would want to see a positive free cash flow with the company. So here what it shows is that the company has spent more than 571% of its cash from operations. This is a never good sign in any company that we invest in. Tata Motors cash earning was 1,63,000 and it still has 37,000 cash remaining, which means that it just has 77% of its cash it has spent out. So as I said earlier, we don't want to see a value of more than 50%. Ashok Leyland cash earning was 11,000 in last 5 years, and it still has a free cash flow of 10,000 CR with it. That is, it has just spent 8% of its earnings or cash earnings of the last 5 years. This is how we look at these ratios. This is a good ratio. SML Issues has spent 110% of its cash earnings. Now it has also negative free cash flow, just like Mahindra and Mahindra. So out of the cash from operations of 307 CR, it has spent everything, and over and above that it has spent 32 CR more for its investment needs as well as operational needs. Sometimes company can go into negative free cash flow, but when it's for a long duration of 5 years, then it's never a good sign. For a single year it's alright, but for 5 years it looks very dicey for investment in these kind of companies. So in terms of free cash flow to the operating cash flow comparison, we see that Ashok Leyland has done the best of managing to keep whatever it has earned as free cash flow, and Mahindra and Mahindra has managed the worst. In fact, it has spent more than what it earned in cash in the last 5 years. Now this of course definitely does not mean that since the company is overspending, then that's a problematic area. But then how well it is managing its debt is also very important to see. Look, when a company is spending more than what it earns, it will need that fund from somewhere else. It cannot spend more than what it earns. So what it does is it has to borrow money from the financing activity. Now when it borrows money, it will have to pay interest. Paying interest reduces the profit, and so it's a perpetual cycle. So we want to avoid going into these kind of companies where the company is investing or growing faster than what it is earning. It's definitely a debt trap for any company which are growing faster than what they are earning. So avoid those kind of companies. Let us look at the average PAT of the last 5 years and compare that with the current PAT of 2018 value. In 2018, Maruti earned a profit of 6,401 CR, which was above the average of the last 5 years, and it was above the average by 43%. For these three ratios, we want to see a above average profit value. Whenever the profit falls below the average, it means the company has not done well in managing to keep its profit above the average. Mahindra and Mahindra's current profit is 46% above its average. Tata Motors' profit fell below the average PAT of 11,000 in last 5 years by 31%. Ashok Leyland's this year's profit has grown at 118% of its average, which is the excellent in the company group. Whereas SML Issues' current year's profit has fallen by 77% below its average profit. See, this is not a good sign. When the current year's profit goes below the average profit, and that too by 77%, that's a sign of worry for investors. So in terms of profit after tax, comparing it with the average PAT, Ashok Leyland has done the best in terms of growing its profit, and the worst performing is SML Issues, which has fallen by 77% below its average. Let's check the cash flow from operations of the companies with its profit after tax of the latest year. The cash flow from operations is of 2018 and profit after tax is also of 2018. So here what we want to understand is, in the last year of the data that we have, how has the company converted its earnings into cash? So the company's profit of the latest year was 6,400 for Maruti Suzuki, whereas it has earned a cash of 11,785 CR, which is 84% above the earnings. This is a good value to look at. Similarly, for other companies, Mahindra and Mahindra's cash has fallen by 88%. Just like in 5 years, it had fallen by 571%. In the latest year, the cash has fallen by 88% of the earnings. So company earned a profit of 5,730 CR, but it has nothing to show in terms of cash. It just has 682 CR of operating cash, which is 88%. We never want to see this kind of a figure. In Tata Motors, the cash has increased by 210% of its earnings. Similarly, in case of Ashok Leyland, the cash has increased by 251%, whereas SML Isus has done the worst, where its cash from operations is turned negative. It had a profit of 8 CR, whereas it spent 33 CR or excess 33 CR in its operating activity. Here too, like in 5 years, Ashok Leyland has done the best in terms of converting its earnings into cash, and SML Isus has done the worst when converting the earnings into a cash component. Let us move on to the micro level analysis. Here we are going to compare the quarter on quarter comparison of sales and profit growth. The value that we are considering is of March 2018 and comparing it with March 2019. This is 3 months data analysis of sales and profit. So YOY, that is year over year, the sales for Maruti has grown at the rate of 1.3%. From March 2018 to March 2019 quarter, the sales has grown at the rate of 1.39%. At the same time, the profit has fallen by 4.6%. Here, we want to see a positive growth rate for both the values, which shows a strength in the company's sales and profit. Not only the company has not managed to grow its sales, but it has even not managed to increase its profit, and in fact there is a degrowth in its profit from its previous quarter. Mahindra and Mahindra sales data and profit data is not available. Let us look at the Tata Motors. Tata Motors sales has fallen by 3% over the previous quarter, whereas the profit has fallen by more than 45%. This is of course not a very good sign to look at, where the profit and the sales both are falling. Ashok Leyland also has managed to grow its sales by just 0.75% over the previous quarter, and its profit has fallen by 11%. SML Isus has done well in terms of increasing its sales and profit. Its sales has grown by 16% and profit by 47% over the previous quarter. In terms of sales and profit growth rates, quarter over quarter, we find that SML Isus has done the best in the short term and Tata Motors has done the worst. Let us move on to the net worth and contingent liability comparison. Net worth is the actual worth of the company after paying off all the liabilities. When the company clears all its liabilities, whatever remains with the company is its net worth or actual value of the company. Currently, the largest of the company is Tata Motors at 60,000 CR, followed by Maruti at 46,000 CR. Now the contingent liability are those liabilities which are not accounted for in the company's books. They are not shown in the financial statement like a normal liability would be, because these are contingent to certain situations or circumstances. They may or may not arise. But here we don't want to pay, or we don't want to have a value, that is, the contingent liability should not exceed 20% of the company's net worth. Maruti Suzuki's contingent liability and net worth comparison shows a value of 17%, which is below 20%, and most of the company's contingent liability has remained below 20%. So in terms of net worth, the largest company is Tata Motors and the smallest company in comparison is SML. In terms of contingent liability, the highest contingent liability is of Maruti at 17% and the lowest is of Tata Motors and Ashok Leyland at 8% each. Let us check the debt to equity ratio of the company and then compare that with its interest coverage. The debt to equity ratio should not exceed 1 times. Whenever the company's debt exceeds by 1 times, it means it will have to borrow more money, or it is borrowing more money from the banks for which it will have to pay interest, and that will eventually have an effect on the profit that the company earns. So we want this debt to equity ratio to be below 1 times. If the company is borrowing money at a good interest rate, then it's okay for the company to borrow from banks and financial institutions. But as far as possible, we have to look at a debt to equity ratio of below 1 times. Maruti Suzuki has no debt on its book. The highest debt is of Mahindra Mahindra and Tata Motors at 1.5 times each. So whenever we find a company having a high debt, automatically we should look at their coverage, and the interest coverage should not fall below 4 times. Let me explain what is interest coverage. Interest coverage calculates how well the company can pay its future interest liabilities or future interest payments through its current year's profit. In other words, how well the current year's profit can cover the future year's payments, interest payments. So Maruti Suzuki, since it does not have any debt, or for that matter to pay any interest, it can cover 139 years very easily with this year's profit. Mahindra and Mahindra can cover just 2.9 years of its interest payment with its current year's net profit. That is due to it having a high debt to equity ratio. Tata Motors coverage has fallen even below 1 year. It cannot even cover this year's interest payment with this year's profit. It means it has gone into a loss. Ashok Leyland can manage 38 years of interest payments. Now, when we look at SML Isuzu, we see that although it has just a debt of 0.5 times, it still doesn't have a coverage of at least 4 times. So this is not a good sign to look at. Similar to Mahindra and Mahindra and Tata Motors, these 3 companies have not managed their debt well. So in terms of debt, Maruti has 0 debt, whereas Tata Motors has the highest debt. As far as interest coverage is concerned, Tata Motors has done the worst. It doesn't have any interest coverage, and Maruti has the best interest coverage of all the companies. Let us look at the promoter holding and if the promoters have done any pledge of their shares. Promoter holding should be above 40%, which shows that the promoters have confidence in the company and they are holding a high stake, because of which they would most probably run the company and try to earn as much profit as possible. The highest promoter holding is in Maruti at 56%, and the lowest is in Mahindra & Mahindra at 20%. As far as the pledge is concerned, the pledge should not exceed 20% of the promoter's holding. If the promoters have pledged a very high percentage of their holdings to banks and taken out loan against that pledge, then it means that in case if they are not able to pay off that loan, then the banks will sell off that pledged shares in the open market, which would directly affect the price of the stock. None of the companies have pledged more than 10% of their holdings. So in terms of promoter holding and the pledge, Maruti has done the best. And Mahindra & Mahindra has the lowest promoter holding. Let us look at the debtors to sales percentage and then compare that with the debtor days, that is, in how many days the company is able to collect payment from its customers, or how many days the company has given its customers to pay for the goods purchased on credit. The debtors to sales percentage measures how many customers are still to pay to the company when compared to this year's sales figure. We don't want this percentage to be more than 30. That is, for this year's sales, not more than 30% should be pending for collection. To give an example here, if the total sale of this year was 100 CR, not more than 30 CR should be pending for collection. When there are too many customers pending for collection or customers haven't paid, then it automatically means the company does not have the money for funding its day-to-day requirements, and it may have to borrow or take out from its bank as an overdraft to fund its day-to-day needs. Most of the companies have managed to keep their debtors at a very low percentage of less than 10%. Let us look at in how many days the companies are collecting money from its customers. Mahindra & Mahindra is taking the highest number of days along with SML of almost a month to collect payment, whereas Maruti is collecting at a quick period of 6.6 days, the fastest in the group. So in terms of debtors to sales and debtor days, Maruti has done very well by keeping its debtors at 2.6% of its sales and also collecting payment from them at a quick pace. SML Isuzu has the highest debt percentage or debtors percentage to its sales. Also, it is taking a large amount of time, that is almost a month, to collect payment. Finally, let us check the net profit margin that the company has earned in the last year, along with the dividend yield percentage that the company gives to its shareholders. Maruti Suzuki's NPM or net profit margin of the last year, that is 2018, was 9.68%. Here we want to see a value of more than 10%. But when we look at the peer group companies, none have managed to cross more than 10%. In fact, Maruti's 9.6% is the highest in the group. Now, since these companies are volume based, that is, they work on volumes, definitely that affects their net profit margin or the margin that they can expect from their sales. So they have to work on a low margin, and value wise it is huge, but percentage wise it becomes less, because with just less percentage they can earn huge value. SML Isuzu had the lowest NPM of 0.75%. In terms of dividend, the highest dividend was paid by Ashok Leyland on its current price, and Tata Motors has not paid any dividend because it had suffered a loss in the last year. So in terms of net profit margin, Maruti has performed the best, and the dividend yield is paid at the highest percentage by Ashok Leyland. This completes the analysis of the companies which are into automobile sector. We'll look at the rating, which companies got the highest rating. Ashok Leyland stands at a first rank at 85 points, followed by Maruti at 82 points and Mahindra and Mahindra at 51 points. I would still not recommend Mahindra and Mahindra because it has a negative cash flow. Until and unless it turns positive for the 5 years, I suggest that we wait to buy into these kind of companies. Now the question comes, how do we time our entry, or where do we buy? So even Maruti we have to wait, because as we saw earlier, the price to book was very high. Let me just get this thing in range. The price to earning is about 25 times. The price to cash is reasonable, but price to book is very expensive at 4.4 times. At the same time, Ashok Leyland's price to book is expensive, but price to cash is just 4.8 and price to earnings is 13. These two are at reasonable levels. We can start buying into this company slowly, gradually, and increase the exposure as the book value also falls below 2.5 or whatever its historical price to book was. In this way, we can time our entry. There is a technical side also to this, which I would not want to go into this video, but if anybody would want to look at, then they can check out the RSI, or relative strength index, on the charts of the company of the weekly frame. I will end my analysis here. One thing I would like to say is that this video is made for my education, and if somebody benefits from the analysis, I would be glad to help. Thank you for watching this video.